All right, let's jump right into this explainer. Today, we're putting on our sell-side analyst hats for a rigorous, fully documented stock valuation teardown of TransDigm Group, or TDG. If you've been following the aerospace sector, you already know TDG is an absolute powerhouse. But today, we aren't just buying into the narrative. We are diving deep into the raw data. We're going to build a comprehensive valuation based strictly on the financial metrics we have right in front of us from the source documents. So get ready because these numbers tell a seriously fascinating story. Right off the bat, we're staring at a massive puzzle directly from our source data. TDG is currently trading at a lofty $1,241.98 per share. But look at this. Our financial extract explicitly lists a discounted cash flow fair value price of just $1,002.14. I mean, that is a massive spread between what the market is willing to pay right now and what the strict cash flow math says the company is actually worth. So what's going on here? This completely illustrates our core dilemma today. Is the market just acting totally irrational, overpaying for a high-flying aerospace stock? Or does a deeper look into our fundamental valuation models justify this huge premium? As analysts, it's literally our job to figure out if our spreadsheets are missing the magic, or if the market is just completely ignoring the math. Here is our valuation playbook for today. 1. The valuation puzzle. 2. Discounted cash flow. 3. Discarded models. 4. Relative valuation. And 5. Our final verdict. Starting with Section 1, the TransDigm valuation puzzle. Let's go ahead and set our baseline rules. Now, because our source material is basically a giant wall of purely quantitative metrics, ratios, growth rates, margins, we actually have to step in and explicitly declare a few sensible external assumptions to make our models function. To bridge the gap between reported financials and our derived values, we're assuming a standard 8% weighted average cost of capital to discount our cash flows. We're also slotting in a conservative 2.5% terminal growth rate, which just accounts for the company's long-term maturity in the aerospace sector. Moving to Section 2, discounted cash flow. This is the gold standard for absolute valuation. Pulling the hard facts directly from the source, you can instantly see why investors love this company. TDG is an absolute cash machine. Over the trailing 12 months, they turned out nearly $1.88 billion in free cash flow. And even more impressive than that is the growth trajectory. We're looking at a staggering 3-year compound annual growth rate of 26.89% and a 5-year rate of 14.77%. It is incredibly rare to see a company of this scale compounding cash at this kind of velocity. So, to build out our DCF model mathematically, we follow 4 basic steps. First, we forecast those unlevered free cash flows over an explicit period, usually 5 to 10 years, using those historical growth rates to guide us. Next, we calculate the terminal value using that 2.5% perpetuity growth assumption we talked about. Third, we discount all of those future cash flows back to today's dollars using our 8% cost of capital. Finally, sum it all up, divide by the shares outstanding, and boom, we get our intrinsic value per share. But here is where things get really interesting. The math strictly dictates a fair value of $1,002.14 based on those cash flows. Because the stock is trading way up around $1,241, we wind up with a deeply negative 23.93% margin of safety. In strict value investing terms, you obviously want a positive margin of safety. You want to buy the stock for less than its intrinsic value. But here, you're paying a nearly 24% premium over the calculated cash flow value. All right, Section 3, discarded models. Let's talk about why, sometimes, an analyst has to throw their favorite tools right out the window. You might be thinking, okay, if the DCF is showing the stock is overvalued, why not pivot? Why not try a dividend discount model to value the cash they're returning to shareholders? Or since TDG is this massive conglomerate of aerospace parts, why not break the whole company apart and run a sum of the parts valuation? Well, scratch the dividend model right off the list. The metrics show TDG has a 0% dividend yield, a 0% payout ratio, and a 0% dividend CAGR over the last 5 years. Management retains exactly 100% of their earnings to reinvest or pay down debt. Without a consistent stated dividend policy, trying to use a multi-stage dividend discount model is just mathematically impossible. And what about some of the parts? Look, TDG operates a ton of distinct aerospace units, all with different risk profiles. But our provided filings entirely lack granular, distinct business segment reporting. Without knowing the specific revenue, margins, and operating metrics of each individual subsidiary, an SOTP valuation is, theoretically awesome, but functionally impossible for us to execute here. So we've got to skip it.
But wait, the modeling headaches don't stop there. TDG has a broadly fascinating and honestly pretty strange capital structure. Our data highlights a negative price-to-book ratio of negative 7.56 and a shockingly low debt-to-equity ratio of negative 3.24. Yep, negative equity.
This completely breaks traditional accounting models. A residual income model starts with a current book value of equity. A net asset value model tries to restate the balance sheet to fair market values. But because this company uses monstrous amounts of debt to fund operations and acquisitions, which effectively wipes out its book equity on paper, we have to entirely discard residual income, asset-based NAV, adjusted present value, and liquidation models. The math just collapses when your baseline equity is negative.
Which brings us to Section 4, Relative Valuation. If the strict DCF says it's overvalued and our alternative absolute models are broken by the balance sheet, let's see how TGG compares to the broader market.
Since we don't have direct peers listed in our source documents, we have to boldly assume an external basket of publicly traded aerospace comparables, companies like HAECO or Woodward, just to contextualize things. And man, TDG's multiples are sky high, a PE ratio approaching 40, an enterprise value to EBITDA over 20, EV to sales at 10.6. By pretty much any traditional relative metric, this stock is priced for absolute perfection. The market is happily paying a massive premium for that 27% free cash flow growth and those 60% gross margins. Finally, Section 5, the final verdict. Let's pull all of this analysis together. The quantitative outputs are honestly all over the map, depending on what lens you use. We've got our current trading price at $12.41. We've got our strict free cash flow fair value down at $1,002, which clearly flags the stock is overvalued. But check out that bottom row. The source data also points to an earnings per share fair value of $1,502. That implies a positive 17% margin of safety. How does that happen? Well, while cash flow is the ultimate truth, TDG's net income and EPS growth have been artificially explosive, like a 78% CAGR over 5 years, which heavily skews those earnings-based models upward. So, what's the play here? Based purely on that deeply negative 24% margin of safety in our core free cash flow analysis, a disciplined sell-side analyst has to rate this stock a cautious hold. The prices just run too far ahead of the current cash generation. But I'll leave you with this. When a company has 60% gross margins, completely dominates a high-barrier aerospace niche, and grows its free cash flow at 26% a year, do you think the market is just seeing a premium the standard models can't capture? It is a fantastic debate, and I hope this teardown helped you see the numbers behind the narrative. Thanks for jumping into this explainer with me.